So we'll kick off with volatility. And I'll just start that as a side note, I was looking, I read an article yesterday and basically about how crazy the market is right now. And so just as a side note, the S&P 500 today is down almost 18% for the year. And that's the worst start of a year since 1970. And so that's pretty crazy. And the bonds market as well. And typically you would invest in bonds when the shares are down. The bonds haven't done really well as of late either. And I won't even start about crypto. So this is a really challenging time for investors, especially new investors, if you haven't lived through a market downturn before. And that's why it's really important to understand what volatility is, how to interpret it in your portfolio, and how to take action. So with that, I'll hand it over to Jess. So Jess, what is volatility?
Thank you, Angela. Obviously, volatility can be, or the concept of volatility can be somewhat scary to us as investors. But in its most basic form, volatility is when a market or a security, so an individual company stock or an ETF, experiences periods of unpredictable and sometimes sharp price movements. Importantly, volatility often becomes a talking point when prices fall, as Angela just mentioned, but it can also refer to sudden price rises too. Now, I really love this graph on the next slide from Morningstar because I think it really illustrates that volatility really is an occupational hazard for the typical investor over really the last 150 years. So this graph actually illustrates the value of a dollar invested in 1870, what that would look like now or in 2020 when this image was created. And as you can see, there's been periods of severe market corrections or market crashes and volatility throughout the period of this investment, which is this investor's life cycle, which is 150 years in this case. And one of the things that I really love about it is it nicely illustrates two key elements of investing, which is it's impossible to time the market, although we do have control of our time in the market. So that dollar has really, really grown and ridden out those waves of volatility over the life cycle that you can see here on the graph. So we know what volatility is, but what causes volatility? So there are 5 main themes, I guess, when it comes to volatility. With the first being political factors. So that might be conflict, or as we're experiencing currently, or upcoming elections, again, as we're about to experience here in Australia. It could also mean, it could also be impacted by government spending. So you might hear that being referred to in the press or in government manifestos as fiscal policy. So how much money the government is spending on various initiatives. In a similar vein, economic factors can impact volatility of individual assets or industries or the stock market in general. And that could be monetary policy. So things like the movement of interest rates, inflation, which we're hearing an awful lot about lately. It can also be consumer spending. So when we get stats from the Australian Bureau of Statistics that talks about how consumers are spending, that can also impact volatility. And of course, things like unemployment rates, which I'm pleased to say are at an all-time low, I think, here in Australia, particularly for women, which is great. So a little bit of a positivity when it comes to unemployment rates, that can impact volatility. And then looking at things on a less macro basis, we have industrial factors. So that might be regulation. There could be a new piece of regulation or legislation that's come in which impacts a specific industry. There could be industrial disruption. You know, there might be an entirely disruptive company or group of companies that come into an industry, or, you know, even perhaps usurp an existing industry. Something like when it comes to company performance, and volatility, it could mean something like a change of management or competitor disruptiveness. And then the fifth one, which I know is definitely front of mind for me, is the investor or market sentiment. So a few recent examples of that have been the GameStop saga a year or two ago, and more recently the tech sell-off. So volatility caused by investor sentiment, selling off stocks or even buying them with gusto, I suppose. So those are typically the main causes of volatility.